All right. So what we're going to be talking about in the future, in the class that I have coming up regarding the buy downs, is how they all work. There's permanent buy downs, there's temporary buy downs, there's multiple variations of the temporary buy down. There's a 3-2-1, a 2-1, a 1-1, a 1-0. There's permanent buy downs. I'm going to walk you through how to properly explain the program to your buyers, and then also how to actually make an offer that reflects what we're doing and how much you need to ask for. So one of the biggest questions a lot of people have is, well, should I just ask for 3%? And then, well, sometimes 3% isn't enough. So we'll go over that in detail. So that's going to be a really, really good class on mastering buy downs. It's definitely needed in this current mortgage rate environment. And we are going to dive into that right now. So let's have a look, kind of see where we're at. And bear with me one moment. Okay, so this is Mr. Powell. Mr. Powell has come out to say he is our Fed chairman. The economy is very strong. That's what all of the numbers are telling us. And that's what the numbers that these lawyers, these attorneys that are running the Federal Reserve, that's what they're being fed. And that's the information they're being given by the data that they're reviewing. So I like to look a little bit deeper into this data. And I like to see kind of what really is happening. What's the truth behind the numbers, which will guide us and tell us where we're going to start seeing rates come down and when we're going to start seeing rates actually dropping. So diving in right now, this is Mr. Fed Chair. He's got a tough job. He has to balance price stability, which is inflation, and the maximum employment. So he's already said he wants inflation at 2%. He's also said he wants the unemployment numbers to be 4.5. Well, if you look at the last numbers, unemployment rate actually dropped. But why did it drop? We're going to dive into that in just a second, because we're nowhere near where we want to be on inflation, but are we? And then we're nowhere near where we want to be on unemployment, but are we? So let's check into the data real fast. This is inflation, right? The cost of goods going up, 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 up. We all feel it. It's not a pretty place right now as far as where we are inflation-wise. Look at these numbers, guys. This is, I'm just going to show you this real fast. These are the numbers year over year of inflation. So video discs and media up 30%, juice and drinks up 27%. This is over 1 year. Motor vehicle insurance, which we all get hurt by, that's up 22%. Now, this is just in 1 year. Part of the reason we're seeing motor vehicle insurance, guys, the bumpers on these cars now have so much stuff in them for whether it's self-driving, all of the different cameras on them, all of the different sensors. So when you get in a bumper bender, it's like $4,000 to $5,000 to replace a bumper nowadays on the low end. So it's crazy expensive now. Insurance has gone through the roof. Repair of household items, services, the elderly care, home care for the elderly has gone up. Everything has gone up, huge numbers. But how is it the average is 3.5? That's kind of where I'm going to dissect a little bit, because there are things that are coming down, but these are the kind of things we feel the most pain in. Look at the prices of candy bars. Are you kidding me? Over $3. I thought this was a joke. I was at a grocery store, CVS, wasn't a grocery store, it was a department or a drugstore. I was just going to buy a candy bar, and then I laughed at the price. So, yeah, I didn't buy that. Cocoa is up 300% this year. 300%. Wild stuff. So let's dig in a little bit deeper. This is the aggregate of the compound inflation over the since 2024. We're at 25% higher. It's pretty wild overall. So that's definitely a spike higher. And then the other thing he talks about is employment. So we're talking about inflation, which we know is up. And then we're talking about unemployment, which if you look at the numbers, unemployment level has dropped. It went from 3.9 to 3.8 or something close to that. But here's the unemployment numbers. And this is, I call it Stranger Things, because this is very strange, guys. Week over week, the unemployment numbers, which are a congregate of 50 different unemployment offices, that is all of the different communities within those states putting their information into one area, and then that information then shipping it out, all the different 50 different places, shipping it out to the federal level, and then them giving us the consensus as to what the unemployment number is, the new unemployment numbers. These are new people filing for unemployment. It's been exactly the same, except for 1 month or 2 months, like almost exactly the same, like 212,000, which I think is very odd. I mean, the statistical anomaly on that happening is incredibly low. So who knows how they're putting the data together, but it is very interesting to watch. So this is John Williams. John Williams came out this last week, and he basically said, I don't think we're going to cut rates. In fact, we may end up having to raise rates again. Now, this is the Fed funds rate. What he meant by that is right now, inflation is still higher. Unemployment is still too low. So there's too strong jobs, too strong in the inflation numbers. The Feds are cutting rates, or they're going to cut rates to slow the economy down. I'm sorry, they're going to cut rates to speed up the economy if it's getting low, right? If the economy is slowing down and there's cracks in it, that's when they cut rates. So when the economy was too hot, they raised the rates to slow it down. Once we start to see cracks, that's when they start to actually lower the Fed funds rate. But the Fed is not telling us they see cracks. Instead, they're seeing it very solid, and they expect potentially to raise rates by the end of the year. That's completely the opposite of what all of the markets thought about 7 or 8 months ago. Everyone thought that the markets would show the cracks about now or earlier, and that the Feds would start to cut rates. That is not the case, and in fact, we could go higher. I don't think we will. I'm going to get into that right now, but this is what they're looking at, and this is what Mr. Powell is thinking. Right now, he's saying the economy is strong, but he's seeing headlines like this: ballooning credit card balances already loom over 2024 retail sales. So credit card balances are very, very high. Credit card delinquencies have surpassed their pre-pandemic levels. That's opposite of what the data is that they've been fed lately. So I think there are cracks that are starting to show. Now, is this good news or bad news for mortgage rates? This is actually good news. So when we're looking at the Fed's cutting rates, they have to see these big cracks here in order to do so. So I think changes are ahead, but I think it's going to be like we're running fast, and then all of a sudden it's going to be like oh, wow, that came quick. I think we're going to start to see these cracks emerge, and I think they're going to show a little bit bigger than what they expected once they actually come to the surface, because I think we're covering them up with false data. Here's some of that data. So if you look at this graph, this is the credit card loans, and this is commercial banks. Look at the spike in the debts right here. Now, mind you, during the 2008 crisis back here, it was really high. And then it came really low during the pandemic because a lot of people had extra cash. There was lots of stimulus, but now we're bouncing, and it's going to be significantly higher. And it's already surpassed the years just prior to the pandemic. And now this is the total credit card debt. Check this out. Now, that's quite the spike. This shows that, yes, we're spending money. Yes, consumer spending is up. Does that show that the market is a good market? Does it show the economy is strong? No, it just shows that people haven't stopped their spending habits, and the credit card debt is going through the roof. So what this shows me is people are not stopping their spending habits. If you look at here, delinquencies are going up and credit cards are going up. That crack, once this starts to stop, once people have reached their limits, it's going to be abrupt. And that's where I think we're going to start to see everyone say, oh, wow, wait, what's going to happen now? And that's when rates will come down. So here's, again, a credit spike: auto loans versus credit cards on delinquencies. This is really interesting, guys. If the economy is so great, right? That's what the feds are telling us. That's why that Fed chair or Fed president said, I think we may have to raise rates because the employment numbers keep going. They're better and better and better. All of the employment numbers say that we're getting better and better. Unemployment is going down. The economy is strong. But look at this number. This is the number of part-time jobs versus full-time jobs. And look at how many full-time jobs are dropping and how many part-time jobs are rising. That's not a sign of a very strong economy. That is signs of employers are cutting their hours, people are getting multiple jobs, they're getting part-time jobs, and the amount of full-time jobs is dropping because employers don't want to pay benefits, whatever it may be, but it's not the sign of a strong economy. So when we hear the Feds talk and we see CNBC saying this market is really strong, they're just looking at the overall numbers of the employment. They're not looking at where these jobs are actually landing on the micro level. So when we look at this, the news, we say, wow, we're in a strong economy. When we look at the actual data behind the scenes, it's kind of a different story. So I think the cracks are going to start to show soon. Now, mind you, this is the group between 25 and 54. This is the core group of employers in the United States. If you look at where the new jobs were being created, they were in the 16 to 24 age group or the 55 plus age group. Those jobs were the ones that were being created that showed the high employment numbers. This sector, these are the major taxpayers. These are the people that when the government needs money to spend money, this is where it's coming from. So the fact that they're losing employers and losing overall jobs on a permanent basis is not a great sign. And I think that's the crack. Remember, we want cracks. We want there to be cracks. The question is, when will they actually rise to the surface? Because they're underneath there. But right now, we've got a nice solid crust that's holding those cracks back. But when they do show, I think we're going to start to see rates drop. I think it's maybe end of summer that we're going to start to see this before the numbers really start to get out. It is a election year. So I think they're going to try to keep that crust solid. They don't want to see cracks during an during a election year. So we're going to see what type of facade is put on by all the different parties in the political schemes. But we'll see what happens here. So what is this all doing to mortgage rates? So we see high inflation. We see really good jobs numbers in regards to low unemployment. What is that doing to mortgage rates? And this is the bond market over the last several weeks. So back to the beginning of April, we were up here, and then we started to see good news. And this was the inflation report that showed inflation was too hot. We dropped a lot. We started to gain ground on this Fibonacci level. We bounced off of it, which is a level of resistance. And then we got another drop last week and yet another drop. We had some good news here. We had some bond auctions that were strong. The 20-year bond auction came in and it had a higher demand than expected because the yields were quite high. These yields, what they're talking about on bond auctions is you and I or different bond buyers were given a yield of in the 5% range. And they thought, you know what, that's a good long-term investment. That's going to be higher than what I think inflation is going to be in a couple of years. So I'm going to buy a lot of bonds at a real high yield and sit on those for the next 20 years. That's what a 20-year bond auction is. And the buy rate on that was quite high. A lot of people jumped in. That tells me that, okay, long-term bond people are starting to think that rates may be coming down in the near future. So I'm going to invest at these high yields because they may not be this high in the future. So that's kind of what this is telling me. But then we saw it kind of come back down. Again, inflation is still sticky. And we're kind of in a mid-range right here. We could go up or down depending on what happens this week. So here's the bond market this morning. We were relatively flat. These are all the different bond coupons that are traded. So if you look at, there's a 6% bond, a 5.5% bond, a 6.5%. There's the Fannie Mae or Ginnie Mae in the 5.56%. These are all different bond levels. And this is what you can buy on the auction. So let's look at actual rates. This is where we all going to go, oh, crap. Mortgage News Daily, this is their posted rates. If you look at actual rates and what people are getting that have normal credit scores. This is based on a perfect scenario. You're in the mid sevens now, 7.44 on a standard 30-year fixed. ARMs are about the same. 15-year, there is some breaks. FHA is a little bit better. But again, this is based on the perfect buyer, 780 plus credit score. Conventional is like 30% down, and a single family detached home on a primary residence. Once you start getting into investment properties, lower credit scores, these rates can fluctuate. Remember, there's hundreds and hundreds of different rate options depending on the person. And each person will have a different rate for their specific circumstances. So when somebody says, what's your rate? I can give them what the average is, but their specific rate may be very, very different. But this is an interesting chart because just 3 weeks ago, we were in the sixes. So the rate spike is here again because of higher inflation numbers being shown and unemployment numbers coming down. So what's happening this week? This is what's going to drive interest rates into this week. So today we had China rate decision. I didn't actually look at that this morning. I'm curious to see how that affected the bond market, but we're relatively flat. So it probably was just as expected. We have new home sales coming out tomorrow. We have a 2-year treasury auction, which is a short-term treasury auction. That's tomorrow. So we'll see how that gets ranked. They grade them on scales of A, B, C, like a report card. We have durable goods orders. We have a 5-year treasury auction. Again, a lot of auctions this week. Thursday, we have GDP. That's going to be really interesting because it's supposed to come in hotter than expected. So we're going to really have to wait and see how that affects the bond market. If it's a lot hotter than expected, expect rates to get worse. But we also have initial jobless claims. Are we going to get the same $212,000 reading? Who knows? But we'll have a look at that. And then pending home sales, and then another bond auction. Remember, our government doesn't have money, and they need to raise money, so that's how they get it. And then on Friday, we have Bank of Japan. We have personal income, personal spending, which I think is going to be quite hot. Again, credit card delinquencies and credit card spending is at an all-time high, so I don't see how the spending will be going down. And then we have PCE, which is another level of inflation. That's coming out on Friday. So a lot going on this week, a lot of bond auctions, and Friday's inflation number to end the week could be another kind of stab in the side. But I do think the cracks are in there, guys. I think that there's a crust hiding the cracks. I don't know how long that will last, but we need to tell people it may last. Who knows? It may last through the election cycle this year. It may not last very long at all. We may see a pretty big crack emerge as we go in through the summer. It's expected that fuel prices are going to go up this summer. We've already seen them go up a little bit in the last month. So it's going to be really interesting to see when that crack emerges. When you start to see those cracks, that's when you're going to start to see rates drop. Now, in regards to, I'm going to stop sharing this real fast. In regards to the actual, hold on one second. All right, in regards to the actual rates and see as far as mortgage rates go, when will we start to see those come down? We're not going to really see them come down until we see inflation numbers coming down and that unemployment number going higher. So once those cracks come to the surface, that's when we're really going to start to see it. Obviously, we're going to keep a really good pulse on this to see what is happening. But in the meantime, buying a home right now is going to be a good idea. Why? Why is that? Well, if everyone's scared of buying because the rates are high, what does that mean for the seller? That means that the seller is not in panic mode, but they're like, oh my gosh, the rates are high. There's not as many buyers out there. They're going to be more willing to work with a buyer. So we all know that mortgage rates go up and down. We all know that. We all know in our industry, in this industry, you and I both know that when the rates drop, appreciation happens faster. There's a lot more appreciation in homes when rates drop because more people are jumping in, more people are going to do above ask. We are still seeing pockets of this market getting multiple offers still. Remember, the median home price of homes has gone down, that just means the average price of home that's actually selling, the homes that are selling the most are in the 400 to 500 range. Those are selling more than others. It doesn't mean the prices are going down. It just means that that sector of home prices is selling more than others. That tells me that first-time home buyers, there's more first-time home buyers now than ever. And those other people that are waiting, maybe they're waiting till after the election. Maybe they're waiting because they have a rate in the twos and they don't want to move up because they love their rate in the twos. So the market is still slow when it comes to the amount of inventory we're getting. It's better than it was, but it's still a lot lower than the normal market. So now is a great time to buy and take advantage of the sellers giving money to do rate buy downs. That is a good segue into my next class, which you'll all be getting an invitation of, on how to master rate buy downs, how to make an offer with rate buy downs, how to discuss that in a buyer consultation with your buyers, how to show them what their payments are going to be with a rate buy down compared to a traditional mortgage, and how to get them off the fence. I do believe that when you buy a home now, they're going to be in a better position and then are people buying a year or two from now, because of when the rates drop, we are going to see that appreciation speed up again. So the cracks are there, guys. They're just hidden right now. They are there. If you look at the true data, all of the unemployment, the new employment numbers, about 75% of those are part-time jobs. So that's not a good sign. When Powell says the U.S. economy is very strong, again, remember, they're attorneys. They are not financial experts. They're just relaying the information, and it's kind of frustrating, but I think we're going to be in for lower rates once we start to see those cracks. So keep your eye on the unemployment numbers. Keep your eye on things like GE saying they're going to cut 200,000 jobs, or keep an eye on that, because that's going to start to give the, oh, okay, it's happening. And if you do have buyers that are saying they're going to wait, and you start to see those cracks in the news saying unemployment, like people are starting to announce mass layoffs, call your buyers that won't get off the fence and say, okay, guys, watch the news. Unemployment numbers will be getting up, go higher in the next couple of months, because look what's happening. They're already announcing job cuts. That's when you want to call your customers, because that's when it's going to start to happen. It may come faster than you expect, but until then, that facade is holding strong. Any questions on what's happening in this market? Anything you're seeing that doesn't make sense that I can help demystify for you? Don't be shy. Wow, am I that good of a teacher that I just answered all of your questions without opening up to Q&A? I'm always available, guys. Every Monday I do this. Yes.
You mentioned a buy down class.
Yes. I can't quite hear you. You're cutting out a little bit.
Oh, I'm driving. When is the buy down class you mentioned?
Yes, I'm going to be announcing that. I don't think we have the date. Christy, do we have that date put together yet?
You know what? We tentatively said the Wednesday, the 1st at noon, although
Okay.
I'm going to say we're probably going to do it the 1st. The time is kind of tentative right now. So we'll get that out in the next couple of days for sure.
So Wednesday, the 1st, which is May the 1st.
Yep.
At noon.
Yes.
Is where we're going to do. It's kind of a lunch and learn. So bring your bagged lunch to your Zoom call and we'll have a lunch and learn. We'll eat lunch and we'll kind of discuss how to master the buy down process. Tell people that you know as well if they want to learn more about it. We're going to send that out to everybody, so everyone has that in their inbox in the next, this week we'll announce.
Well, I was going to say, I'm going to even try to get it out today or tomorrow, so you'll have it soon.
Okay. Watch for the cracks, guys. They're there. They are there. I mean, we see it in the data, but will they let it out? Will they expose the cracks before an election? Who knows? Let's see. There's 9 new messages here. Let me go here. We have to dig deeper for the truth. Yes, we do. Always. Let's see. Everyone I know who is unemployed is laid off. Had to sign up. Interesting. Non-disclosure to receive a severance package. That is interesting. People laid off had to sign an NDA, non-disclosure affidavit. Huh. Very interesting. Yeah, so watch for the cracks, guys. We know when the rates are going to drop. You know, because you're educated, when unemployment number starts to go up, that's when rates are going to come down. We'll see these little bumps in the road when we see good auction results. That means that people have adopted the fact that rates will be lower in the future, and they're going to go all in on investing on these higher yields. So when bond auctions get really good attention, that means that investors are willing to go long term at the interest rates being offered now in the fives. That means they're banking on the fact that they're not going to be higher in the future. So that's a good sign for lower rates, but those cracks, guys, they're being hidden, and we need to keep our eyes out for them so we can properly advise our customers. But in the meantime, check out our May 1st class, Mastering the Buy Downs, because you need to know, you need to become the master at that when you're initially talking to people. Because usually they go to you first if they're looking to buy or having that conversation to buy. And getting us involved early is a very good thing as far as the lending standpoint. And I can show you side by side 4 different scenarios showing a 3-2-1, a 2-1, a 1-1, a permanent rate buy down, and current payments. So you can show to your buyers how much lower you can get their payments the first couple of years. So remember, always, rents always go up. The mortgages always go down. Now, why is that? Because unless you're struggling, you never do a cash out refinance, or you never do a refinance to get a higher rate. Usually when lower rates present themselves, you refinance and get a lower payment. So a homeowner over time always has smaller payments going forward, whereas a renter, they always have a higher rent going forward. So nobody really talks about that. The fact that they look at these rent versus buy and they always keep the same rate for the life of the loan. In reality, that rate's always going to drop. So now, if you were in the 2s, it's not going to drop. But in the 7s, heavens, yes, you are definitely going to have lower rates in the future. So we should absolutely make sure they understand that this is a temporary payment, that the future will look very bright for them. And we can show them, okay, here's what you're going to buy now. Here's what it's going to look in a year or 2. Because we know rates are going to come down. We just know, when is that crack going to rise to the surface? That's the major question. And we all thought it was going to be sooner rather than later. I think if the markets were honest and the data was more transparent, I think we would have seen it earlier. But I think the inflation numbers, they're kind of ridiculous. So they've kind of given up on that a little bit. And again, if they raise the Fed funds rate, like this last chairman or the last president said, Mr. Williams, if they raise, I think that's going to widen that crack that's going to come to the surface even more. So I think that would be a major mistake because all of these people with credit cards, their minimum payment is based on the Fed funds rate. And if that minimum payment increases even more and those car payments go up even more, the crack's going to widen. So what I don't want to see is that they mask it, and then after the election, then the crack is exposed. I think that's not fair to the American public, but that's politics. That's kind of what they do. So just be prepared for what just prepared to see the cracks. Keep your eye on the news for when layoffs are going to start happening. And then
Sure.
you will be the expert to tell your customers when to start seeing rates drop.
So, Sean,
Yeah. Any other questions? Melissa,
Yes,
you have a question.
my dog went crazy for a second. I keep hearing that the next like Fed's meeting, or when they come, like rates could be cut is September or something like that. Does that mean rates won't have any big fluctuations until September? What does that like mean?
Potentially. So the Feds, keep in mind, they said that there was going to be 5 in October of last year. They said there was going to be 5 rate cuts this year. They said that they're going to be a Fed funds rate cut in June, and then they're saying no, it's going to be July, And no, now it's going to be September. So basically what that means is the Fed funds rate, they're going to lower it by a quarter in September is kind of what the projection is. Kind of in line with where I think the cracks are going to start to show, but we'll see. So the Fed funds rate would drop by a quarter. When that happens, I think just before that, we're going to start to see the data. That data will show that the Feds need to start cutting the rates. Remember, the Feds need to cut the rates when all of a sudden there's bad news in the economy. If the market's slowing down, if unemployment is higher, they cut the rates to kind of somewhat stimulate the market to keep the unemployment numbers level. They don't want all of the companies to come out all at once and say, we're laying off half of our staff. And then all of a sudden the unemployment spikes and it goes from 3.9 to 6%. They don't want that. So they'll lower the Fed funds rate before that happens to kind of give it a little bit more of a stimulant. It's almost like if you're putting your foot gas on the pedal and all of a sudden your engine starts to overheat. So you pull off the gas a little bit and then it starts to cool down. And then you lay off the gas a little bit more. It starts to cool down even more. And then it gets too cold. And then you have to put the gas to get up to speed. They're trying to be the cruise control of our financial markets. That's what the Feds are trying to be. They want it to be steady. They don't want the gas up, down, up, down, up, down, because then it's going to make all of us sick, right? You ever been in a car with one of those drivers that floors it and then backs off and floors it and backs off? They don't want that to happen. That will make our markets dizzy. It's a great analogy. I'm going to use that again. But so that's what the letting off, and that's what the lowering of the rate is going to be. It's going to be to cool it down a little bit, and then they're going to push on it again when it starts to go too cool. And that's why the Fed funds guy thinks he thinks it's too hot right now. So that's why he wants the rates to go up, because he still thinks everything's too hot, but he's not seeing the crack. I've got my 3D glasses on. I'm looking at under the surface and I see a crack, but how long will it take to get to the surface? Any other questions? Buyers are still wanting to buy homes, guys, so stay in front of them. This is actually good news that we're starting to see these cracks, even though they are still below the surface. It's good that they're there. It's good news. Now, the question is, when will they surface? So we'll all watch that. You guys enjoy your week. If you need anything, I'm always here for you. And again, MondayMortgageUpdate.com. You can share that with your friends, family, if you ever want it. If you have a buyer that's on the fence and you want them to see this, share it with them. MondayMortgageUpdate.com. You can go right into Zoom that way. So you guys have a great day. And down payment assistance, yes, DPAs, they are all still out there, Michelle. In fact, our zero down loan as well is still available. So there's lots of low down payment options. And if you can have the sellers pay for all your closing costs, you can get into a home with zero out of pocket. They do need their earnest money up front, but yes, DPA. I assume that's what you meant by that.
Yes, just because of like the governor's announcement, that question like is every buyer's asking, what does this mean? What does this mean? How do I get this? I'm like, it's been around forever. This is nothing new, but
the DPAs.
Yeah.
So different DPAs are funded by different parts of and different groups. If it's county based, a lot of times those monies are reserved up to a certain amount and they run out. Some are national, some are city based, municipal. We do have one that is national. That is a down payment assistance. We have a second mortgage in-house that we put on an FHA loan to do, instead of a grant program where there's golden handcuffs attached to it. We have a program through FHA where we fund that 3.5% in the form of a second mortgage. So we can do a zero down FHA, and we follow normal FHA guidelines as well. So DPAs are good. We have a couple, I think, that are better options, because most down payment assistant programs, they give you money, but then they say, well, nothing in life is free. So the rate ends up being significantly higher. The fees end up being a little bit higher. And they say, if you refinance it before a certain time, you need to pay some of that money back. So there are some handcuffs. I call them golden handcuffs on those. But we definitely have options. And I'm actually right in the middle of putting together a side-by-side scenario showing 4 different DPA options for first-time buyers. and I'll get that out to everyone as well.
That's
this
what I was
week.
going to ask next. So good.
Yeah.
So Sean, I have
Perfect.
one question. Do you have any type of a program where if they buy a house and say they want to put a pool in, can they get a second loan or equity out or anything like that to do something like that?
Good question. So most rehab loans, they do not include non-structural items. So pools, hardscape, any type of landscaping, they don't include that. It's just the structure itself. So if you wanted to get a new home and get a pool, you would have to go through the pool company to get a private pool loan for that. Sometimes builders will include the pool in their total cost if they have a partnership with the pool builder. But if it's an existing home and they want to put a pool in, the only real way to do that is to get a private loan for that, or put less down. Some people say, you know what I want to do? I'm going to be putting 30% down. We'll just put 15% down and then keep the cash to pay for the pool. Or if they're doing 10% down, let's do 0 down and then pay for the pool with cash. So there are different ways of doing it. If it's 0 down and then they also want a pool, tell them to cool their jets. Wait, maybe they shouldn't do it right now. But if they are putting a lot down, just put less down and pay for the pool separately. Yeah. And we all know that when you get a pool and you get a bid, it's like 30 grand, 40 grand. And then all of a sudden the guy meets with you and they go through the final things. And you're like, oh, I wanted to change that to this. And oh, you know what? I really wanted a grotto. And you know what? Let's go ahead and go with the Pebble Tech. I know we're going to do plaster, but it looks so cool. And now it's 80 grand. So you have to be careful, but I think working with the builder on a new build may be the solution. If somebody really wants a pool to finance in, they may offer that. Good question.
No, finding a resale with a pool is the answer.
Yeah. Yeah, no, that's impossible. Unless, of course, they're doing 20% down, then we just do less down. And then we basically finance the cost of the pool by reducing their down payment. But if they're already doing like 5% down, remember, keep in mind the lender gives you money based on the value of the house to rebuild the house, the value of the foreclosure, the pools. You never get the same bang for the buck when you pay $50,000 for a pool. What does the appraiser give you? 15 to 20, right?
That's why it's good to buy the house with the pool already.
Exactly. Yeah, because they never give you the true value of what it costs. And guess what? We know that as a lender. So we're not going to say, oh yeah, do it. And then, oh, you can't make the first payment. Oh, we're screwed. That's the reason why. Good question, though. I wish that product was available. If you were to look in 2002, oh yeah, we had it back then. And we had 125% loans back then. We said, you know what? You have student loans. Let's just roll it all into a mortgage. And they learned real quick that doesn't work out very well. So here we are. Any other questions? All right, guys. Well, I'm always here via text, email, courier pigeon, whatever method, send it my way. I'm here to help. And you guys have a phenomenal weekend. Keep an eye for those cracks.
Bye, Sean.
Have a phenomenal week. Thank you so much for joining us.
Sean, can we talk today?
Absolutely.
All right, I have some ideas. Maybe
You got it.
Bye.
All right, have a good day.